All right, so listen, there's a lot of people talking about how to build wealth through real estate, but I want to show you exactly how we are doing it. We just closed on our biggest acquisition to date, a 351 unit deal in Houston, Texas. I'm going to break it down. I'm going to show you the numbers. I'm going to show you how we're doing it, our renovation plan, how we're increasing revenue, and literally how we are going to create tens of millions of dollars for us and our investors in this deal. I promise you, once you get finished with this video, you will know too exactly how we are multiplying and building wealth through real estate, and I'll show you exactly how you can do it with us. Let's roll. Like I said, it's one thing to talk about, it's another thing to actually show you what we're doing. That's what I want to do in this video. So yeah, 351 unit deal in Katy, Texas. First off, the reason why we love this area, we're buying a great asset, brand new building from a developer, fully stabilized in a great market in Houston, Katy, Texas. Median income is way higher than the country's average, which is really good. There's incredible job growth there. That's what you want to look for when buying apartment buildings, when buying real estate, is job growth, right? Is income. Are you insulated from a downturn, right? Do you have good paying tenants that can afford dips in the economy? So for that reason, we really like this building. We really like this location. Like, let's just do the math so I can show you exactly what we did. We bought 351 units. It was $76 million purchase price. The bank, okay, the bank gave us, and this is what you need to know right here, because this is the time that we're living in. There's incredibly cheap capital out there, and this is how we leverage debt in a great way to go buy appreciating assets. Don't go buy debt, man, to buy stupid stuff. You want to leverage debt to go buy appreciating, cash flowing assets. So we bought a $76 million to purchase this deal, right? $76 million. The bank gave us $59 million of it, $840,000. The bank gave us almost 80% of the debt to go purchase a $76 million building. But the other $24 million is what we went out to our investor base alongside us and our partners and went out and raised the capital from investors. Now, we're paying them much more than we have to pay the debt, because the debt only in order to, for this is 3.25% interest. So let me break this down for you. We're borrowing almost $60 million of debt to go buy this building at 3.25% interest rate, which means I got the math down here, by the way, so forgive me, I'm not doing this in real life, but I did this before so I can show you great details. Our debt on this project, that means our debt payment, what we have to pay every year is I did it right here, $944,800, right? So this is our annual payment. We have interest-only payments for 5 years. So our debt on this is $1,944 million. Sounds like a lot, right? But here's the crazy thing. When we bought this deal, the trailing 12, right, the income that was already coming from this property whenever we bought this property was already 3 million, essentially some change, right? 3,100,000, it wasn't exactly that. But so we're buying the building. The bank is costing us $1,944,000 to own it every single year. But the tenants are already paying us $3.1 million. And here's the crazy thing. We're in a market where rents are going up 15% a year. So this is increasing 15% a year, and this is staying the same. So you can see, man, why we love leveraging debt to go buy appreciating, cash flowing assets. Because as this stays the same, this goes up. So our cash flow increases even though our payments stay the same. But that's just the cash flowing side of things. Let's talk about how it really gets juicy, because cash flow is what we always talk about real estate is, but the real multiplier is the equity, right? You really want to multiply wealth in real estate. This is the magic formula, and let me break this down for you. We're buying in a cap rate market, so the cap rate in this market is 4.25, okay? And this 4.25% cap rate. And this is really important. I need you to understand this equation, because the way that we make money, the way we multiply wealth in commercial real estate is a very simple formula. And the formula is this. It's NOI, our net operating income, so this number right here, divided by the cap rate, 4.25, gives us our end value, what someone else is willing to pay for that deal, okay? And so, again, think about what I just said. This is going up 15% a year. I mean, maybe that slows down, that's okay, but let's just say that's going up 10% a year. That means with every dollar that we create, that we build, that we add to our NOI in a market of 4.25, that's $23 of new equity that we create with every dollar of new income. So how do we multiply equity? One, what we buy in appreciating markets. The rents are going up. But like I told you, we're always looking for value to be added in these apartment buildings. So in this one, in particular, we bought this from a developer. Okay, so this was a developer who built this property and who brought in a company to stabilize it so that he could go sell it. That was to us. One of the biggest things about developers, and this is a trick that you can know, they're trying to stabilize this up as fast as possible so they can sell it and get their equity out. And there's something on the operating statement called loss to lease. And this was a massive number that we paid attention to. And the reason this is important is because you think about this. If his goal or the developer's goal is to get it stabilized, it means that they're probably leaving a lot of money on the table. So in fact, when this developer started leasing this deal 12 months ago, rents have already increased by 15% in this market. Not only that, but they were offering concessions to tenants, meaning, they were giving them a couple weeks free, or maybe they would, throw in something to incentivize them in order to lease up the property. We don't have to do that anymore. So over the next 2 years, our goal is just to burn off that loss to lease, to capture what the developer left on the table. And our goal and what our target is and what we believe to be very realistic in this property, when we go to sell this deal, 5 years, or we typically are underwriting for a 5-year target, we're expecting our income from $3.1 million to go to $4.35 million. Now, why is that significant? Take our same equation. If we sell into a market, let's say things stay the same. I expect them to get better in this economy, but let's just say they stay the same at 4.25%. That means we have a new value of over $100 million. In fact, it's $102 million and some change that we've created a new value through purchasing this real estate, sitting back and just let it do its thing, but also finding ways, in this way is not even, we don't even have to go and spend money to do this. We just have to operate it more efficiently, and we can create tens of millions of dollars of equity for us and our investors in this deal. This is why the number of units is the most important number in real estate, because of the multiplier effect, right? 351 units is what allows us to go do this. And so if you're serious about multiplying wealth in a predictable way that's backed by a hard asset, this is how you do it through commercial real estate. If you want to learn more, if you want to do that alongside of us, click the link below or go to symphonycapitalgroup.com. Sign up as one of our investors and come start looking at deals with us. We'll show you the deal before we go buy it. We'll show you exactly how we're going to go do this. And if you believe and trust in our business plan, you can invest alongside of us and all of our investors to go buy deals exactly like this one. This is how you think wealthy. This is how you multiply capital through real estate investing. Have a great day. Cheers.